Hey traders, Siam here. So we have now finally hit that 50% retracement, so as in the pullback from this big old crash on the US 30, and it's the same for the other indices. They're there or thereabouts, 50% pullback. So I thought I'd do a little sort of deeper dive in this, and you've probably done this already. I mean, I've done this a lot already, but I've jumped onto the Dow Jones macro trends. It gives us some good data, unlike Fxcm, because we only get about 20 years of data with Fxcm, whereas this gives us all the data, well, some of it, 100 years at least. And I've looked at the Dow US 30 and gone back to 1929, and yeah, so this is basically how it looked. Now, the reason why I've been a bit stubborn on my crash trading account is because I'm using history as my guide. Now, I know past performance is not a predicator of future performance and all that, and you shouldn't exactly rely on history, but it doesn't always repeat itself, but it does rhyme really well. But normally it rhymes with a bit of a sinister tone or tune. So looking at the US 30 here in 1929, we had that big old sharp gasp. It was like, whoa, what's going on here? And then look, we had about a 40-50% retrace, and then we attack those lows. And when you attack those first lows, you tend to get a bit of resistance, and then it's game over. And then you always have some sort of bottoming pattern, whether it be a double bottom or a triple inverted head and shoulders, etc. So that's that. The next big real recession we had was 1966. So if we have a look at 1966, here we go. So from top of drop to bottom of the first one, we then have, guess what, a 50% retrace. And it looks like, yeah, so I guess this would have caught out a few people. This dash down here would have said, oh, a lot of people probably thought, it's time to, it's going to go even further. But then we had this sort of double top. I guess there's a head and shoulders, and a big old double top all together. But anyway, re-attack that level, so we've got to be careful of that if that happens again. And then game over, and then we had a bit of a inverted head and shoulders before it recovered. Whoopsie, I've zoomed in too far here. So that's the, oh shit, I'm doing it again. Stand by. There we go. So that's that. Then the next, let's zoom out even further. As you can see, it was a pretty horrific crash, the 1966 crash. It went on for about 15 years. It was nuts. No one ever talks about it. You can see there the inverted head and shoulders very clearly. Anyway, then we go to 2000. Then we had the tech bubble. Now this is inflation adjusted, so it looks a bit different than a normal chart. But as you can see, it's a bit higgledy-piggledy. This you can't really see much, but you can see that there's some. I'll look at the Fxcm charts in a second, so you can see clear a bit better. But long story short, we do get some sort of pullback, before rolling over. Like here, big old gasp down. Or this went beyond 50% pullback, and then it was game over. And then we see the same thing happening somewhere over here. Now let's look at the Fxcm charts. So here on the right hand screen is the daily chart. Now what I've done, because this is literally the fastest crash in history, I've left this on the daily chart, and the other charts we're going to look at are on the weekly chart. So here, and I'm just going to compare, this is just a simple comparison type thing. Now it's a bit messy over here, but I guess I'm going to use this bit here. Now obviously looking at charts, everything's a bit subjective like this. So we have the a proper gasp down where it really shocks everyone and everyone goes, oh my god, shit the bed time. This is something to look into here. And remember, this is a weekly chart, so things play a lot faster than what's happened at the moment. Then we have the inevitable pullback. So that pullback, I guess, is very similar to what we're seeing over here. Starting to go back, as you can see. And on the left-hand chart, if we can just do a quick fib retracement from there to there, it attacks that 50 level. As you can see, if you zoom in a bit, it attacks it, goes all the way down here, and it probably goes all the way down here, because as you can see the wick, and then it just goes, suckers, and then starts probably destroying a few more shorters, and it hits the 61.8% retrace level around here, and then basically, oh my lord, sorry, a 70 odd percent retracement level, and then it rolls over, and we've got a bit of a head and shoulders here. I mean, that would have been horrific. I mean, if that happens on the Dow, for me, that would be horrific for me personally, but but yeah. And then as you can see, we always have a re-attack of this level down here, and as you can see, it did. And then we had a bit of a bounce. So there will be some horrific bounces along the way down, but you can bet your bottom dollar it will at least attack this level again. Then we had a bottoming pattern, as you can see here. It's a bit of a weird double bottom. So that's the tech bubble crash. So I guess there are some similarities, but it's not as clear as the 2008 crash. So here's the 2008 crash. We had a bit of a it depends which one you look at first. I mean, you've got some little bits and pieces here. So I guess if you were to look at this top here, it's a bit like this move down here is very similar to this bit here, where we have a bit of a pullback, which I guess is this bit here. So I guess from top of drop here to this bit here, we had a 50% pullback there, and then we attack that bottom again. If I just do this, you can see. Then we had this here. Okay, so we had, oh my lord, the markets are ending. Jesus, what's happening here? And that, I believe, that takes us to where we are around here. So the markets really hit the bottom. You have a lot of moving around, as you like with the previous one, and then we start doing the proper pullback. And as you can see here, if we take that top of drop to here, we had about a 50% pullback before again re-attacking these levels. And yeah, classic breakout there, breakout, kiss off the level, and then continue falling a long way. So that is basically the 2008 crash. If I just get rid of that. So yeah, I believe we are here. This level here, I believe this 50% pullback level is pretty much what's happening here. We hit this 50% level. Now, you can look at other crashes. Oh yeah, by the way, we had an inverted head and shoulders as the bottoming pattern. So yeah. So looking at this, I believe we will roll over. Now, I don't know where though. I mean, there's nothing stopping it from hitting the 25,000 level, which I said originally would be a key level to re-attack, because there's a bit of a support level at this bit here. I'm genuinely hoping it doesn't, but I mean it could. So you've got to be prepared for the market to have a little gasp up here. But then it's time to roll over. So there's one thing I'd like to show you on the 2008 thing, which happens quite a lot actually. Where is it? It's probably on the daily chart really. If we look at the daily chart, what you tend to find, what I find, is that there tends to be double tops. Here we go. Here's the daily chart. We have the big old crash. Then we have a pullback. So this is that 50% pullback. And then we have what it looks like a double top, as you can see here. So it hits that 50% level, pulls back, gets people excited that it's going back down, and then we have another attack at that level. Again, it's a key 13,000 level there, another high test, as you can see, and then it starts to fall. So be wary. If this does start to fall again, we could come back down and then it will go back up again to attack this 50 level before going back down here. So yeah, I'm playing a long game here with my particular trades, and again I keep on thinking, you know, what's stopping this from going all the way back up here? Well, the Fed, all the central banks are printing and doing all sorts of stimulus, so that, I mean, it could force it all the way back here. But as I put in the Facebook group, like, when you look at the fundamentals in the short term, fundamentals can get put on standby. and then you get fundamentals in the short term. But when you look at the real fundamentals, I mean, just look at this. In the last 3 weeks, 16 million Americans have been made jobless. When this was announced, we had an 800-point rally. It's just absolutely, it's crazy. And this is the same around the world. Everyone's losing. The world's engine has just run out of cogs, basically, and fuel. So eventually fundamentals will come back in, and yeah. So hopefully that makes sense. And I will see you later. Toodles.